markets have been shocked by fears of potential tightening efforts recently. First, we saw jitters about the Fed possibly tapering its quantitative easing program. Second, we saw concerns about a liquidity squeeze caused by China's shadow banking system. Credit Suisse's Global Chief Investment Officer, Michael Strobaek, is with us now. Michael, have markets been overreacting?
We think they have, but we also think that the reaction is justified given what the Fed has surprised almost everyone with. They came out and said that they believe growth forecasts for the US are actually better than what consensus expected, and they also indicated very strongly that they're going to turn down the volume of purchases of bonds actually much sooner than everyone expected. And what we saw was a sharp reaction from the markets, in particular in emerging market debt and currencies, essentially leaving those asset classes for now and seeking newer homes, which probably is going to be more in the developed world. But it was an overreaction.
We've also seen a sharp correction in equity markets. Does this present a buying opportunity, and how does this look in the long term?
Right here and right now, we advise caution. What we have seen with the changed language from the Fed is increased volatility across all asset classes, and we will have to carry this volatility at least for the next couple of months. And we advise to wait, and if equities indeed were to fall further from here, we will consider buying. The long-term outlook for equities, we believe, is still intact. Valuation is still very attractive. Growth is coming back in the US, and this is good overall for equities.
You also mentioned the loss of momentum in emerging markets. Is this a fundamental trend change, and where else can investors look to for good returns now?
We don't believe it's a fundamental trend change for emerging markets. It is clearly a repricing of emerging markets. What the American Central Bank has triggered is basically a capital flight in certain sectors. But value has now also opened up in good credit issuers. We advise clearly not to take very poor quality credit issuers, but in this flight out of emerging market, good value in certain sectors has opened up. Also, we're seeing that as this repricing takes place and capital leaves the emerging market, we believe that actually developed markets will become more and more attractive, in particular if they continue to fall from here.
In China, we're seeing less demand for commodities as a result of the cyclical downturn. What can investors expect from this asset class in the next few months?
Well, we have become more cautious on commodities in general. China has slowed down, but is in an important transition away from an investment-led economy to a consumption-led economy. So China will probably need less copper and less steel. And this is also a regime shift. Secondly, and this is very important for commodities, it seems as if real yields have stabilized, and if anything, they've gone up in the recent past, and that has historically not been good for commodities. So overall, we have decided to take our strategic recommendation, if you will, back to neutral, meaning that the super cycle in commodities is probably over.
Thanks, Michael. For more news on market movements and global trends, check out News and Expertise on the Credit Suisse website.